Hey everyone, Michael Reynolds here from Massage Business Blueprint with a video supplement to the Path to Financial Independence column in the ABMP's 2020 Mind Your Money series. So, we talked a lot about the path to financial independence or retirement or whatever terminology you'd like to use in the column. So, I'd like to unpack the investment portion of it a little bit in this video. I'm just going to spend a few minutes here just kind of unpacking what's inside of these accounts a little bit so you understand kind of what the terminology is. So, again, we talked about things like a Roth IRA, like a solo 401k, like a taxable account. Those are all types of accounts you can use for investing and saving for the future. But what do you put inside of those accounts? We talked briefly about investment models and what you put inside of investment accounts, but let's talk for a few minutes about mutual funds and how to understand what you're reading, what you're looking at, what the landscape looks like for mutual funds. So we talked about mutual funds being kind of a big basket of stocks and bonds, or stocks and or bonds really, that kind of diversify a risk among lots of different types of companies or types of investments. So mutual funds make a really great option for investing and putting those inside of your Roth IRA, your solo 401k, or your taxable account. So one thing to keep in mind, this is not specific advice. This is not tailored to you specifically. This is general education to think about and to help you understand what you are looking at when you look at mutual funds. So mutual funds are, again, they're kind of collections of stocks or collections of bonds. So first of all, what is a stock and what is a bond? A stock is a tiny piece of ownership in a company. So when you're buying a stock in, say, Apple or Microsoft, for example, you are buying a tiny little piece of ownership in that company. And when the value of that company goes up and down, the value of that stock goes up and down. So a mutual fund can be a collection of stocks. It might have hundreds or a couple hundred stocks even inside a single mutual fund. And what that does is that spreads out the risk a bit. So if one or two companies or even a handful of companies have, bad quarters, a bad year, or the stock price goes down, it won't necessarily dramatically decrease the value of the fund overall. So it's a way of really spreading out the risk and kind of not putting all your eggs in one basket, so to speak. You're putting your eggs in multiple baskets, so you have that potential diversification. A bond mutual fund is made up of bonds. And what is a bond? A bond is a tiny microloan to a company. So if a company issues a bond, the purchaser of the bond loans a little bit of that money to the company. The company then pays it back with interest, which is the return you get on that bond. And so a bond fund is made up of a bunch of different types of bonds. Bonds can be issued by companies, by municipalities, by government, by the federal government. So a typical bond fund is going to have a mixture of different types of bonds as well. So bond funds are also sometimes called fixed income. So fixed income is another word for bonds. Equity is another word for stocks. So if it's an equity mutual fund, it's made up of stocks. If it's a fixed income mutual fund, it's made up of bonds. That's kind of a good way to look at them. Those are two general categories you're going to see in mutual funds. So breaking that down a little bit further. So within equity mutual funds, you're going to have different types. Sometimes you will see what's called a total market index fund. Vanguard makes these very popular, Schwab, a lot of the big players, Fidelity, they have what's called total market funds. And what that means is it basically takes the money you invest and invest it in this broad mix of companies across the entire stock market, from small companies to mid-sized companies to large companies. That is a really good way just to kind of have a simple approach and just kind of diversify among the entire stock market from a stock standpoint, from equities. You can also break that down further and you can see what's called large cap funds, mid cap funds, and small cap funds. Those target a specific size of company. So a large cap fund would target larger companies. These are big, huge companies like the S&P 500 companies. A mid cap fund would be mid-sized companies, and a small cap fund would be smaller companies. So the cap portion means the size of the company. So small cap, small companies. Mid cap, mid-sized companies. Large cap, large companies. Now, again, while I can't tell you specifically what to do, I will say that a lot of people tend to diversify across all three general categories, small cap, mid cap, and large cap, by either getting 3 mutual funds or getting one total market fund that crosses all those categories. You also will see what's called international mutual funds. An international mutual fund is a non-US mutual fund. This will give you broad exposure to non-US companies. So these are going to be anything besides the US. So an international company or an international mutual fund might invest in European companies, Asia Pacific, different regions of the world, and that gives you that diversification outside the US as well. A lot of people will put a small portion of their portfolio or their investment money into international as well, anywhere from none of it to up to 25% or more. Again, I can't tell you specifically what to do, but generally people put a small kind of portion into international. Then you're going to have things like emerging markets. Emerging markets are markets that are around the globe a little bit newer, developing areas of the world. They have potential for growth, but it's a little more volatile, a little more risky. And those are sometimes included in people's investment mix. Not always. If they do, it's usually a smaller percentage. Again, I can't tell you specifically, but usually a smaller percentage is what people do. Also, you might have real estate mutual funds, which invest in real estate. It might be commercial or residential real estate. Some mutual funds invest in gold and precious metals. They might invest in commodities or other things. So those are a little less common, but when you look at a mutual fund, you can look at the composition of it and you can see what it's invested in. Again, if you want to keep it simple, the most common are total market equity funds or small, mid, large cap international. You also have total market international funds as well. So those are going to be the most common. Most people would generally invest in just kind of a broad mixture of stocks throughout the US and possibly some international as well. Now, on the bond side, the fixed income side, typically a decent bond fund will be pretty diversified. A total return bond fund is kind of a signal that it's a total mixture of bonds from government to corporate, et cetera. And so you're going to have a good mixture there. So why do you want bond funds versus equity funds? Fixed income versus equity, bond versus stocks? What's the difference? Stocks tend to be more volatile. They tend to be a little riskier. They tend to go up and down more. And so the more stock mutual funds or the more equity mutual funds you have in your portfolio, then the more up and downs you're likely to see. Historically, you would have seen bigger ups and bigger downs. So for example, in early 2020, in February, the stock market took a big dip. It plummeted quite a bit. And a lot of people that were all in stocks or majority in stocks saw their account values go down quite a bit. Now, that could be stressful, but again, if your time horizon is longer, 10, 20, 30 years, then you have time to recover from that, and that's just kind of part of the ride. But if you're closer to retirement or you're closer to that financial independence number, you likely would want to be more conservative and you might introduce more bonds and more fixed income into your portfolio, which is going to level that out a bit. It's going to be typically less volatile and you're going to see fewer big ups and big downs. You're going to see ups and downs, but it's not going to be as dramatic. And it's more designed to preserve the value you have and not see those dips quite as much. You likely won't make as much of a return, but at that point, the goal is not necessarily high returns, it's preserving what you have. So again, the heavier towards stocks your investments are weighted, the more volatile it's going to be, and typically the higher return you're going to get as a trade-off. The more weighted toward bonds or fixed income it is, the lower the return's typically going to be, but you're going to have less volatility and a smoother ride, and that's the trade-off. So that's kind of the difference. So when you're looking at choosing investments, it's always a great idea to get professional advice. But even if you're not working with someone in a professional sense, it's really good to get information on exactly what you're investing in, how to look at mutual funds, what the terminology means, and just kind of how to understand what your portfolio is. So with that, hope that's helpful in helping you understand what types of mutual funds exist and generally what they're used for and generally what they mean. So any questions, definitely send us a note. Contact information is available in the article and we'd love to chat. So thanks. Have a great day.